everyone. I think firstly I would like to thank the Excellency in terms of explaining to us how important the India-Paris relationship or France relationship is, and also the role of INR in terms of allowing and pushing India towards a developed economy much sooner than we all are projecting. As usual, it was always a pleasure to hear Honorable DG Mr. Ravi Shankar, who spoke about the vision of INR over a long-term perspective, reminding all the AD banks about its roles and responsibility in ensuring an orderly market, and of course to FEDAI as it embarks on its role as an SRO in terms of the additional responsibilities. I know I'm probably holding a lot of you for that evening in Paris, so I'll probably jump straight into the questions. So probably I'll start one for you, Mr. Ajith ji. When we look at INR, do you think we are going to be in this scenario of the low volatile region is all moved out, but do you think we are seeing a structural change in terms of volatility of INR for it to stay?
Yeah, it's a structural. First, thank you, FEDAI, for having me here. Thank you, everybody. It's a structural change. It's not a structural problem. It has to be differentiated. It's a structural change because economy has been opening to external sector, and that beginning started in mid-90s, and result started to come in and around 2000, so that we can assume that 2000 is a cutoff year. Take some of the statistics like say trade as a percentage of GDP. By trade I mean merchandise and invisible import and export. It was 15% in early 90s, moved to roughly 30% around 2000. Couple of years back, it's almost 50%. Similarly, in terms of foreign direct investment, we are the fourth largest recipient as far as the greenfield investment is concerned. And to take a leaf out of DG speech that economy has to become bigger, stronger, and has to integrate with global market. And the moment we integrate with the global market, structure will have it in such a way that volatility will be obvious. And it's not a problem, it's a reflection of our integration to the global market. And no economy can develop unless we have an energy sufficiency, and 90% of our crude is imported, 50% of the gas is imported, and in terms of total import basket, our energy basket would constitute 30% in terms of value. So with these structures, it is not possible to have something in isolation, and this structure is structural change is for good. It is not for bad, but we cannot remain isolated. That if entire world is facing some sort of volatility, we will be isolated from it. We can't afford to be isolated. It's a part of the growth problem, and that will continue going ahead also.
Yeah, Vijay, I would like to add here. If you look at our country, India presents a classic divergence between our economic growth and the rupee strength. For the last few quarters, we have been growing very well. Growth was around 7%, 6.8, 6.5, sometimes 7.2, whereas currency, it didn't appreciate. In fact, it should appreciate, it didn't appreciate. One more thing, as rightly told by Ajith, ours is an import-dependent economy. Most of the things we import, we have a lot of trade deficit. We have to become a country from trade deficit to sustainable surplus kind of country. Then only things will improve. That I would like to add.
Oh, thank you, Srinivasa ji and Ajith ji. Assuming this volatility is going to be a constant feature, less temporary and probably more structural, for the reasons that you have mentioned, and probably Arup, I'll probably come to you in terms of markets, right? What are the kind of policy measures do you feel that the market is waiting for or hoping for or anticipating if such kind of volatility continues?
So
difficult to say whether the market is expecting or anticipating any policy. You put the difficult questions to me.
That's true.
And sitting in front of all the entire regulatory team, it's a very difficult one. But no, let me put it in a different light. I think the volatility is here to stay. Now, why should there be any specific regulatory / policy measures to take care of it? I think it's a factor that each individual business has, each individual corporate, each individual bank needs to figure out how to measure that volatility, how to manage that volatility and the risk associated with it. The policy measures are more to do with the fact that there is a currency which has its challenges because of import-led or a trade current account deficits which we have. The challenge comes in that because last 1.5 years our capital flows have been weak, which is leading to this kind of a sharp movement in the currency movements which has happened. Till before that, we have been a current account deficit country for years, but capital flows were taking care of it. Now, for some structural reasons and otherwise, capital flows have been a little challenged in the last couple of years or last 18 odd months, and that is leading to it. So, my personal take, we don't think that, there may not be too much of a policy measures changes which needs to be done. We'll have to be very nimble-footed in how to handle volatility. But volatility is here to stay. I mean, you don't ask for policy changes when there is a volatility in the equity markets. People don't go to the SEBI to say, bring in regulations to control volatility. People learn how to handle it. So my point is that.
The markets will brace for itself. But very fair point, right? Because in terms of the trade, what you mentioned is fair because that's how structurally we are built up, and some of these things can't be undone or changed overnight. Which, and that's why probably, Panigrahi, I'd like to, ask you your thoughts in terms of how do we get larger capital flows into the country? Because that, in times like this, that is a delta that we get and soothes some of the market nerves.
Just now Arup spoke about capital, whatever flows, which country should get on a continuous basis. Ours is basically capital account deficient country. So the whatever flows we are getting, it should be on a continuous basis. Last year, if you see the data, FPI outflows whole year, 20 billion outflows were there, $20 billion. Whereas FDI inflows to the tune of 80 billion, it was there, but it was not adequate. It's not at all adequate. We need more. For that, what we have to do? First of all, we keep talking about potential, the India's potential and the demographic dividend and the large working class. So many positive things we keep talking. But now we have to shift to predictability. From potential to, we have to shift to the predictability. Because there is no clarity. FPIs, they are investing and they are getting disturbed, they are getting troubled by your taxation laws. Lot of confusion in taxation. There is no clarity. That predictability should be there. Lot of reforms have to be undertaken in respect of taxation, especially for FPIs. Then only they will come back. We are all aware. It's all in public domain. It's nothing confidential. Look at Jane State case. Yeah, Tiger Global. So many companies. Sometimes we go for retrospective tax. Some clarity should be there. Some reform should be undertaken, and something country should focus upon it. Then only the whatever forex flow, the capital flows, what we are expecting, we can get back. Likewise, we always talk about the China +1, that strategy, China +1. We have to shift from China +1 to supply chain plus. We have to build up our manufacturing hubs. We have to focus on that. Already government has undertaken so many measures in respect of semiconductors everywhere. Many states, they have started focusing on semiconductors. Especially Gujarat, they have been doing very well. Earlier we were only talking about fabs. Only there we were stopping in semiconductor. Now we are we have come to the stage of manufacturing those things, competing with the global players. We may become means we may source the equipment to the other countries also. That Atmanirbhar Bharat or whatever you make in India, that we have to focus more. Not only that, along with that, other things also. We have to semiconductors, like electronics, lot of opportunities. Government has kept 40,000 crores aside for electronics sector to give impetus to the manufacturing facilities wherever states or whatever entrepreneurs they are focusing upon. These things we have to focus. Again, look, data centers nowadays. Data centers is in the one of the important area country needs to focus upon. Recently, few months back, Google first time, they never invested $15 billion in a country other than US. They invested in India. That's a great news for us. Likewise, we have to focus on this niche areas where the manufacturing capabilities can be ramped up. With that, automatically the continuous forex flows would be there, capital flows would be there. Similarly, whatever reforms we have to do at various levels, even we can talk about the trade pact, whatever FTAs government is undertaking. In the last 2 decades, we have signed more than 100 regional or bilateral trade deals. We have to leverage those trade deals. Recently, mother of deals, we signed with India, signed with the EU. That has to be implemented. There is still uncertainty about the USA-India trade pact, when it will get completed. As of now, we don't know. But whatever we did, whatever trade deals, whatever free trade agreements we have undertaken, we have to implement those ones. We have to get the benefit out of it. We have to leverage on those strengths. These are the basic things we should focus. Then the continuous capital flows would be there. We are sure, I am confident country is on the right track. We will attract capital flows. Only some geopolitical tensions or whatever headwinds are there, those are getting some impact, negative impact on the country, but over a period of time, in the long term, we are on the right track.
But Vijay, I'll just add, on capital flows, I actually look at it as it's a strange positive, because if you look at the FPI market, as Mr. Panigrahi said that, FPIs are probably leaving the country, maybe they're finding the valuations too high. But there's a good SIP story, right? You're seeing the local investors get in. Today's SIP has become a national saving. Similarly, on the FDI side, it's not that money is not coming, but India is such a robust IPO market after the US. It's giving fantastic exits. So if a financial sponsor put in $200 million 5 years ago, he's taking $2 billion out. So hopefully the fresh $2 billion will come in with the hope of taking money out.
No, I agree, Brejesh, right, and Panigrahi also, right. I think the mood of the market typically goes one way, right, and there is a lot of negativity and news that is surrounding us today. But on that note, I would like you to maybe speak about some of the positive things that are happening in India on a structural basis that's leading to the growth story that we continue to have. I mean, we need to pat ourselves on the back. We continue to be the fastest growing economy, right, of the size that India has.
So, most people will remember we had in 2004, India Shining was the theme. It didn't land so well, and now this time we're talking about Viksit Bharat arriving at a 10 trillion economy. So the question is, will we get there this time? And honestly, I think, even if you poll the room, Vijay, you will probably get a fantastic or a fabulous yes. And it's many things. Even if you start with the government itself, stability does help. If you have this is the government with third term in power. So if you have policy, as Mr. Panigrahi said, then you have stability in policy. Markets love stability. We had, the RBI government talk about inflation. Even with the oil shocks, I don't think any economist is predicting more than 4.5% for inflation. So inflation under control, you have stable policies. Yes, dollar rupee, we're all aware that rupee has depreciated more than it does, but I think Shamsherji mentioned that $700 billion is not a small amount in reserves, right? That's 11 months of imports that you have. Fiscal deficit. We have a government between state and at the center. You've kept fiscal in control. That is possibly why India is getting its rating upgrades and will continue to get that. We did always have the demographic dividend. We had it earlier also, and I think we probably have it for another 20, 30 years. Today, you probably have more young people, twice as many young people as old people who are working, right? So the point is, you have demographic dividends, you have inflation under control, fiscal deficit. What else is the government supposed to do? I think the main thing we expect from governments is infra. If you look at the last, decade, and you must give them some credit, there's, I don't know, 13,000 projects, and look at the large ones we're all aware of. Bharatmala highway project, Sagarmala, Udan, which is 90 airports, 4 crore people will fly, Bombay-Delhi corridor, which is a $200 billion project. So, you can just go on, and apart from the physical infra, what India is doing is we're building the digital infra tech as well. So you've got UPI, Aadhaar, you go to the airport, you've got DigiYatra, DigiLocker, smart metering, and all of this built on very smartly, I would say, cheap data. Today, if you go to the US, 1 GB of data probably costs you at least $4, $5. Here it is what, 10 rupees? 10 cents? So India is using, I would say, the internet very smartly to kind of bridge the gap between, the haves and the have-nots. And finally, if you want to future-proof India, then again, as Mr. Panigrahi said, India is taking AI chips very seriously. I think every country has committed a certain percentage of their, spend to GDP on chips. India's matched the US, India's matched Europe, defense, renewables. So I think we're future-proofing it, and hence, I would say the structural story is very robust. As Mr. Ravi Shankar said, markets go up and down, but I think it's a solid story.
I agree, and I think this is where the domestic India retail has actually come up to the fore. It's amazing how FPI contribution in Indian equities is below where retail and corporate is, right? And it's continuing to grow in that direction and holding up the markets. Arup, since you get all the easy questions from me, well, markets are volatile. We don't know where rupee is going to open tomorrow or not, depending on how Iran and US go. So how are you advising clients?
I think the customer side of the business needs to be like, if the customer has an expected, when they are doing their budgeting on a particular rate, they should try to cover that rate. A hedge fund is in the business of playing on currencies, but a customer is supposed to do his own fundamental business. They are supposed to manage the risk, and that's been that's a philosophy which any good business houses would do. Yes, they may play with some portion of that from getting an incremental kicker on it, but treasury is not a profit center for corporates, and it should not be a profit center for corporates. It's not a finance company are different, hedge funds are different, but in India when we are looking at it, and in India it's a hedging activity which needs to be done. So from a perspective of advising customers, I think the advising has been always that if you can you can cover your budgeted rate, that's the best approach. At least take a certain portion of that, cover that certain portion of the risk, and if you want to have an element of that risk open, so be it, and you play whatever you want to do with it within the parameters of the controls of it. But there's a larger thing. I mean, you asked about you bring back the volatility part of it. See, I think we as a country worry only when the currency depreciates. Let's go back 19 years back, 2007. Currency was appreciating. There was not this kind of a talk. There was, even then FEDAI used to run, and there was no debate on why the volatility on the other side. The exporters were getting hurt, but there were nobody discussing it. So I think at the end of the day, the currency level is a number. I mean, $150 yen, nobody says that Japan is a weak country. So the point I'm trying to say is that at the end of the day, volatility is being smoothed out, currency volatility needs to be smoothed out and all. I think Mr. Ravi Shankar made the statements also and everything. But and Governor also said that in his press conference a couple of days back. But we as a country start worrying only when the currency depreciates. But if we want to move to an export-driven economy and things like that, we should be wary on both sides.
And you're rewriting the rules of the skew.
Arup, in probably 2007, we were not complaining about a stronger rupee because holidays were cheaper, maybe for.
No, I mean, when it was, there was a target of a 39.70 being spoken about, or a 35 being spoken about also in those days.
Different days, different times. So, no, Brejesh, it's very good that Arup has mentioned that corporates should behave like corporates and they should focus on their hedging once they have their targets, etc. set. Are corporates behaving like corporates in this time of, market volatility? And beyond just hedging, right, is this now seeping into the way they manage liquidity, the way they look at foreign currency borrowings? Is it going beyond just, I would say, current account item to a balance sheet item?
So I think whatever is happening globally is obviously impacting our customers. And all I can say is, I feel everything is, a lot of things are now policy driven. It is policy that is probably, like look at tariffs. What happened was, and if you look at how that impacted supply chains, and as a result of that, if you want a corporate to hedge, how are they supposed to hedge? If today the very fundamental of which they're hedging is changing. So take, some small place like Tirupur, right? Very centered towards exporting to, the US. You have tariffs, what happens to them, right? Suddenly, there's no dollar rupee to have hedged, right? Or if they've hedged, then what happens because the exports are not coming through. If you look at the auto industry, Mexico's center for offshoring for auto components. So if you are having INR Mexico peso trades, now suddenly all of that is going to BRN and other currency pairs. Mr. Panigrahi correctly mentioned, I don't think we realize, again, the impact of policy. Today, you mentioned FTAs, right? The regional trade agreements. Out of the 440 billion exports that India has, historically only $100 billion or $110 billion was covered through FTAs. In the last 12 months and in the probably next 12 months, we will have $200 billion going through FTAs, which means a corporate will suddenly see massive influx in GBP, Euro, Swiss francs, Aussies. So the hedging requirements are also going to change, is the point I'm trying to make. Second, if you look at traditional customer, Arup was right that corporates should look to hedge, and he used the right word that this is the budget rate, they should look to protect that. But when the underlying business is changing, it gets a little harder for them. So forecasting is going to be a little fuzzy, if you ask me. The future, is changing every 3 months or 6 months. So I would say till then, of course, corporates should take advantage of, if there's a ceasefire and you did see dollar rupee come down, then that's a good point to come in and hedge, because dollar rupee was trading at 94.70, and now if you're getting 92.70, you should buy. So I would say long-term strategies might, I don't know, Arup, if you disagree, but long-term strategies might.
I don't disagree. I just wanted to add a point which you asked him about the capital flows part of it. I think the element of risk in the corporate balance sheets from a capital transactions in foreign currency is a lot lower than it used to be earlier. So from that,
Deleveraging that's happened.
Corporate deleveraging has happened. There is especially among the a little evolved corporates which have gone into foreign currency borrowings and all, they have policies which they take care of it. And if one were to look at it and at a macro level on the unhedged foreign currency exposures piece and all that, you get to see that the risk on the corporate balance sheets are a lot lower. And if you see the balance sheets and analyze the balance sheets, it's reflected in that. So from that perspective, yes, the current account, what he rightly said, what Brejesh rightly said, there's a lot of uncertainty coming in because of the geopolitical environment. But from a capital perspective, I think the corporates have taken it in the right spirit and have done some things right.
I think most of them have been quite nimble also in terms of when to borrow in foreign currency and when to move to local currency. So to that extent, I would say...
Yeah, Vijay, I would like to add here, the volatility in the currency is helping the treasuries to convince the management for going for hedging. And this is the right time. They should come up with proper risk mitigation strategies and the hedging products. Various products are there. It's customers should utilize these opportunities, and some customers are getting benefited also. We are aware of that. Whom it's an opportunity for making money also. Within the guidelines, within the norms, if they are making some money, that's okay. We should not take it differently for that. That's my view.
Yeah, another point, just to take it out of earlier participants. We like some of the financial instrument only till the point we get benefited out of it. For example, capital flow. Just to give it a small example, last year our bond got included into JP Morgan Emerging Market Index and Bloomberg Emerging Market Index. That led to the flow. Similarly, there will be other investment which would be coming through foreign route, and they will put some volatility, may not be big enough. But please note that these investors are there to make money. And there will be time when they will wind up their investment or try to book profit. That at that point of time it will lead to volatility, and we have to learn to live with it rather than hating it, because hating may not be option. Because if that money is coming, that profit has to book and money has to go back and then come back again at a suitable time. So we have to, all we are supposed to do is to manage it rather than making that volatility is a villain kind of concept. It's not there.
Well said, well said. Ultimately, it's a cycle.
Ajith, I would like to add here. Last year only, the FPI outflows were there, 20 billion, but domestic inflows were there. Oh, that is evident. Markets didn't get corrected. Only after this war, markets got corrected. So domestic, anyway, money is coming in. That's good thing. Even SAP flows, every month 30,000 crores. Recently, it has gone up to 32,000 crores. These are all resilience of the Indian economy. These are the indications.
Yeah. Sorry, I couldn't help but chip in, but as Ajith correctly mentioned, people will invest in our bonds and they will exit. But this is where those structural reforms also come in, because as you effectively get better, your rating upgrades happen, more and more funds will be forced to add India to their pool, right? So larger funds will come in, there's more money allocation to India, so the exits will happen, but somebody else will, come in place of them. And then that is also where policymakers, time markets. So for example, the recent ECB relaxation, I mean, it's fantastic, right? Today corporates there's no kind of floor ceiling, they can use the money however they feel, and they can use markets to see which is the right place to, use and level that money. So.
There is no doubt that the path that the country is growing will continue to grow. But let me come back to you, Panigrahi, because you mentioned about new products, advising corporates, etc. Where do you see the opportunities in the FX markets beyond hedging, right? New products, investment products, etc. Your thoughts around using INR as a tool to further augment our economy?
All these products are very important. We cannot ignore any product, but in my mind, in my view, cross-border payments we need to focus upon. There are a lot of opportunities, and a lot needs to be done also in that. As in the initial remarks I told about it, FPIs, that whatever flows we are getting, we have to give them some clarity about the taxation. Similarly, bond inclusion happened. Again, recently they are pulling out money due to various reasons. When they see some structural problems, they go away. When they see some negative press coverage about the taxation, the government, IT department going after some investors, all these things, it gives unnecessarily negative press coverage. When these things happen, foreign investors, they try to leave the country. When Jane Street issue happened, many FPIs, they shopped their shops here. They went to other geographies. They went to other countries, they invested there. So these things we have to take care. So still cross-border payments, an important area we should focus upon. We have to become the trade deficit country. it has to come from trade deficit to surplus. How long period it will take, no one knows. So for that we have to increase our manufacturing facilities. Recently, a few months back, I visited Foxconn unit in Chennai, near to Chennai in Sri Perambudur, it is there. They started the manufacturing facilities in Chennai. They manufacturing it, they assembling. They import everything from China. They assemble here, again they export. They are doing $40 billion of turnover, huge turnover. Most of the foreign banks are taking away that business. I went there for pitching our products. It didn't get materialized, but we will not leave it. All other banks also we should try. So many opportunities are there. Not only Foxconn, so many other entities also there. They are coming here. When I entered their office, they opened so many subsidiaries. So many boards are there on the first floor where I entered. Because in multiple subsidiaries, they must be claiming whatever benefits we give. PLI, but that's all allowed. Within the regulated norms, within the guidelines, they can do it. But why can't our Indian entrepreneurs, our industrialists, they also should focus upon it. When we ramp up our manufacturing capacities, when we increase our bandwidth, then only country will become the trade is surplus.
Isn't that happening? So this Make in India, PLI, look at our PLI schemes,
Yes.
right? 14, 17 schemes, 2.1 lakh crores. What this mobile, mobiles that we've become recent exporters of, it's all because of these schemes. So I think, I don't know whether we'll be able to cover the oil deficit which we have. Renewables will still while away, but Make in India is the way.
No, I wanted to add something else to the question you asked about new products. Before we get into new products, we are all treasury professionals here sitting in this. The DG spoke about internationalization of INR. How much effort are we making in our day-to-day life in making that happen as traders, as dealers? AED INR, AED dollar is a fixed peg. Why are we not ready to quote AED INR as a banking fraternity? I'm not talking any specific individuals, any individual bank, but we are asking for policy changes, we are asking for people to push this through. Why as a country, if we really want this to happen, why can't we start? Dollar AED is largely a fixed peg. We can start with an AED INR as a trading pair.
Well, CCIL is working on it with hopefully by next year. But
CCIL
that's on the
can work
pricing.
on it, but even otherwise, I'm saying, why not? And there is UAE India is almost at a balance of trade is quite even. So you can actually start this a lot more easier than with a country where there is a huge deficit kind of a situation.
Fair point, fair point. Yeah, we'll probably move to you, Ajith, now in terms of, we all prepared like Q1 and everyone's looking at long break and holidays going into April 1st, I guess. Coming now here seems to be a well-deserved break after all the things that we have seen in the last 2 weeks. But do you see something more happening in the market? Is market prepared for the next bout? And are you worried?
I would be worried, but like this question can't have an answer which fits all. We have to divide affected participant into 3-4 categories, and at the top rung of it would be people like us, banks having a strong treasury, primary dealer, hedge funds, those who understand the market, and they would know that going may not be good all the time, and they would be prepared. And additionally, we have a very good risk management tool in form of daylight limit, stop loss limit, intra-loop limits, PV0 and VAR, all those things. So we may not be affected, or if at all we are affected, we may have a wherewithal to handle it. And similarly, top-rung corporates who can have treasury and economy surveillance team as good as a bank would have, probably they would also not get affected. And probably they would try to diversify their raw material sourcing and finished good dispatch also. They may not be affected. A mid-run corporate could be borderline. But as a market participant, I'm really worried for the smaller players, including MSME, who leave everything to the chance. And probably they are the most vulnerable lot, and many of them get wiped out with each bout of volatility. So I think as a market participant, since we are the one who face customer, it's our responsibility to convince them to remaining hedge and not to play with the volatility. That way, our bigger corporates have evolved excellently during last 20-25 years. When I started working in Treasury, I remember some of the bigger names, without taking names, they would have a Treasury as good as a bank, and probably it was one of the profit center. It was supposed to be profit center, but I realized that every year they would make losses, huge losses. And as of now, I don't see, like majority of those trading units have been dismantled, and they are focusing on their brick and mortar business. Assuming somebody is a steel manufacturer, probably he would try to explore bigger market, new processes, new raw material sourcing. And they have evolved, but I'm a little worried about the smaller lot who get affected most due to volatility. And either maybe they may get directly affected, or they may be affected because the client to whom they are serving, it could be B2B or B2C, they get affected. So I think they need some tutoring at this point of time.
Sorry, I wanted to add something. It's because you asked whether the next bout can come and what can be the impact. I don't think it's just about the treasury part of it or a foreign exchange volatility part of it. Depending on how this pans out, your underlying economy can come under stress, and that can have very multiple different impacts. And it's not just about the existing war scenario, but it's on a overall global situational scenario. We know a lot of the money outflow happened because the money was going into AI investments in the developed worlds. AI investments is leading to a pressure on certain kind of jobs. If those kind of jobs get impacted, job losses start happening, then the second order derivative of that can have a real different challenge. And as bankers first and treasury resources second, we need to be cognizant of the kind of risks the systemic risk which can come in.
And I'll just add one more point to that. In fact, we were just discussing this at tea, that, the AI risk is, of course, one is jobs. It's a very real thing. And on the other side, you have one AI company which probably has 500 employees, which has a market cap of, whatever our software companies have. But from an FX perspective, think about our software companies. They've been pulling about $30 billion every year, 200 billion going to 230 billion. What if some of that business slows down? So this year what we had was the capital issue, right? That is why our net BOP has been negative. If IT slows down, you could have a 30 billion hole next year, which will again impact dollar rupee, apart from, of course, economy, what Arup was correctly mentioning.
So Arup, I still want to pull you into this. You're worried on trade or worried more on capital at this point of time?
Immediate worry on trade, depending on how soon the issue settles on the Gulf side. If that settles, then if the supply chain becomes easier, then the trade can still be managed, and then the capital kind of comes back into the trade. If you ask me, immediate concern is trade.
Okay, I'm going to ask one to all of you, right? And we do have something called as a... Oh, we got a timer. Oh, okay. Okay, this is really a simple one. It will be kind of quick fire. So we do have something in Citi that we do, which is, a greed versus fear indicator. So let me just ask on the fear side to all of you, on a scale of 1 to 10, 1 being least and 10 being most feared, where each of you are, I just need a number, 1 to 10, in terms of the fear in the market.
This is fear on account of...
just fear in terms of market and where we are right now. 1 to 10.
1 being the least.
1 being the least and 10 being the most. I just want to get a market, a pulse of...
7.
6. 4, 5.
Probably played safe 6.5.
Okay, now you go next, because my next question is to you. Where do you see dollar rupee end of June?
That's tough. So yes, we did see rupee appreciate a bit. I reckon 94. You should see rupee probably inching up, because I don't know what geopolitically will happen again. And given what's been happening, assuming something else does happen, you could see rupee inch up 94 handle somewhere.
93 to 94.
What settles 9150?
That's a one.
That's a one. Well, but you are more feared than you are on the positive side, Ajith.
It should be around, say, 91.5 to 93, because given the interest rate differential, in a secular term, rupee has to depreciate only. It can't appreciate. It can't appreciate, but there will be turbulences. But 92 something is the present level. 91.5 to 93 there should be levels, but more towards 93. It should be tilted towards 93.
It's somewhere closer to 92.5, 93 as a panel. And but of course you spoke on interest rate differential. I know it's not FIMDA, but still, where do you think 10-year G6?
Which tenor? When?
June, same tenor.
Acha, month.
680 to 7, that 20 basis point band should be there. 680 to 7, more towards 7, less towards 680. But this could be 20 basis point broader range during last 2.5 months.
Arup can go. You can do the averaging.
7, 10.
6.80.
No range. Wow.
6.80 to 85.
No, but like I said, assuming geopolitics do happen and that rupee is not 93 handle, it's 94, then inflation continues. So then I'd be on the Arup camp more towards 7, 10.
Oh, thank you, fantastic. I now would like to. Oh, it's 5.5 minutes. Very efficient, YG. But I'll open this up now for Q&A for the audience, please.
Hello. Yeah. Very good evening to honorable panel, and thank you, FEDAI, for organizing this. I'm Hardik from Treasury of Bank of Maharashtra. So, my question to panel is, as we heard our honorable Deputy Governor mentioning that there should be one INR rate for, let's say, onshore and offshore, right? So, internationalization of rupee, that's what our objective is now. I'll sync in this with the recent RBI circular regarding gap of NOP of USD 100 million, right, wherein there was definite turbulence in the market with regards to onshore-offshore covering. Okay. So, what's the opinion of the honorable panel regarding this? That will this kind of gap be a short-term measure, and also is this step going into the right direction of internalization of INR and having a one rate for onshore-offshore market? Yeah.
Wrong group to be answering this question.
So,
I think DJ has answered it very correctly. I mean, there is nothing more to, at least for me, to add in this.
Even in RBI MPC statement, governor also spoke about it. It seems it's temporary. Once things stabilize, they may give some. I think they may make some changes.
Yeah, what Deputy Governor said today is that the philosophy remains the same. There are steps which has to be taken at times because the way the market and the environment behave. So you have to take it in that right spirit in that.
Correct. No, taking in the right spirit itself, but just understanding the global, let's say, impact from, let's say, senior seasoned people. So, okay. So
at that point of time when rupee was depreciating, even it crossed 95, above 95.
Yes,
it was a right.
It was a right move. Definitely, it's in right.
The
move.
part of the regulator.
Correct. Okay. Yeah. Thank you.
Good evening. I'm Deep Jyoti Das, Treasury from SBI. My question to the panel is not exactly related to the markets, but my question would be like, you just spoke about how AI is affecting the entire scenario and has a second order derivative impact. So how do you see AI being handled by India in terms of infrastructure development for AI development, so that we can cover losses due to maybe cover job losses or stuff like that, which further impacts the economy and volatility. So, are we ready for an AI-related investment and a boom in our country?
Few months back, Narayan Murthy clarified about it. Infosys, that ex-chairman or whatever it may be. So what he says, even AI also will create lot of opportunities. Initially, you may be having the impact of job loss, all those secondary effects, but that field itself, it will create a number of opportunities. All companies will start recruiting the people for AI. That's happening already. Most of the companies, they have started, even TCS, which is the largest employer in the country, they have also started recruiting the people for only AI.
So also if you look at banking itself, I mean, you know, if you ask many people who've been around for a while, there was this whole era when there were unions and strikes against computerization, right? And look where we are today. So I think, you know, but you know, you also said a pertinent thing about AI. See, there is a narrative also that maybe India has missed the AI bus, and that is probably one more reason why FPI money has been leaving India a bit. So I think we've been trying to do that. And if you know, I talk to a lot of corporates, and almost every CEO I'm talking to is working on something on AI, including our banks, each one of us.
I think it's a brilliant question. Let me just add this question a bit for you guys. You do see, you know, the equity side, quant trading, etc., come up, and of course offshore there are a number of, you know, quant-based funds like Reliance, etc., who do a very good job of it. Now, from a banking perspective, do you think banks are investing enough in their own internal models for developing AI-capable tools for, let's say, market making or trading INR?
Yes, especially risk management, banks have been using, and fraud detection.
So,
A lot of opportunities.
so Vijay, I think you
Banks have to embrace the technology. They have been doing it.
see, but you know, see, honestly, I think, you know, India has so much of automation itself to be done that I'm not saying AI is not required, and people have to leapfrog between both of them. And you know, every bank, every company is trying to do stuff in AI. But yes, probably in treasury itself, if you're saying, I don't know too many treasuries that are working on AI models to trade, but eventually it'll pick up. Look at algos today. The algos have helped, and quant trading has given amazing liquidity. You know, there's lesser slippages, real-time, you know, order filling. So I think AI will only be positive whenever it comes. But has the big wave come? Possibly not yet.
No, I was reading of an offshore fund who actually during, you know, their MPC equivalent speech, they put in AI tools just for looking at the facial recognition, looking at the facial patterns of the speakers, and that actually directs some of the trading at their firms.
I want to leave the house with a different thought. We are all talking about AI, and we'll all have to adopt AI, and possibly everybody has a ChatGPT or a Google Gemini on their phone to may help them write letters also. Where would you get this kind of energy to sustain this kind of AI development? The kind of energy requirement, and that's a question.
Putting a very touchy point on energy in this market.
I agree, but that's a question which has not yet been answered. I mean, everybody is talking about it. There are suggestions that fission and fusion kind of energy generations will happen, which has been tried for 80 years. It has not been successful yet. There are talks about quantum taking over and helping it design. So I don't know. I mean, we shouldn't end up in a blockchain kind of a situation where there was a huge uptake and then suddenly people realized the kind of energy requirement was not sustainable. So yes, AI is a reality, but to what level? It's just a food for thought for them.
I think YG, you should be very happy. See, from FX to rates to economy, we have swung to AI and global warming, widening the scope of it.
Another facet of AI, like the kind of fear you are expressing, when computerization started in India in mid-80s, similar fears were expressed, but regarding job losses and people getting redundant. But it has added a lot of value, and those who got redundant, they reskilled themselves. Similarly, for AI also, there are some of the things which we know, there are some of the things which we don't know. Probably we are looking for the answer as an ecosystem, but there are many things where we don't know what we don't know. The way things will evolve, probably the system will be very resilient, And those getting redundant through AI, they will go for some sort of reskilling, and they will, I think, strengthen the ecosystem. Some parallel need to be drawn what we had for computerization in mid-80s. Similar figures were there.
Thanks so much, panel. I don't know what tomorrow holds for me, but what I do know, we have overshot our time, so I'm going to end this panel discussion here. So thank you again.
I have one question.
Oh, okay. Can't say no to FEDAI.
Initial years of my career, I have seen that dealer used to depend much on the economic and financial theories, and people used to wait for the release of the job data. Now I think dealers are looking more on the truth or X, what is happening. So how long this profession will survive as a, you have to be professional even on economics and financial, or you need to be pundit of predictability and probability.
Then I think Governor Ji mentioned that we are not going to be sole 100% hedge fund traders, we're going to be market making, so that profession still will exist. And as long as there is a certain set of people who are authorized dealers, so again, I hope that doesn't change.
Bharat, let me answer it differently. You still need teachers, even though the likes of online teaching worked.
Very true, sir. Thank you.
Should we close now?
YG, thanks a lot. Very well organized event.